Hello and welcome to the Forex Form Guide. I'm Aussie Dollarman, and each week I take a look at the major currency pairs through the lens of WD Gann analysis. If you're new to the channel, welcome. It's great to have you here. I've put together a playlist for you of videos that I think will bring you up to speed quickly and give you the most value for your time. If you find some value in my videos, I'd really appreciate it if you could click the like button and leave a comment. It does help the video get pushed out to more people. And my intention with these videos is to help you and also to spread the work of WD Gann to those who are seeking it and to those who need it. And if you'd like to, I'd welcome you to subscribe so that you can keep up to date with all of my latest videos. In this episode, we'll be taking a look at the Aussie dollar, US dollar, the pound, the euro, and the US dollar yen. Before we do that though, a quick disclaimer, this video is for educational and informational purposes only and should not be considered as financial, investment, or trading advice. Bottom line there is do your own research. It's not financial advice. Trade responsibly. We'll kick off with the Australian dollar, US dollar. And for those who are new, I like to refer you to WD Gann's book, The Wall Street Stock Selector, page 46, and how he laid out his charts side by side. A lot of people will just take a look at one time frame chart, like a daily chart or a 4-hour chart or a 1-hour chart. This chart is a great reminder for us that Gann looked at multiple timeframes side by side. He didn't just look at one chart. He had the yearly, monthly, weekly, and daily. I tend to look at the monthly, weekly, daily, and 4-hour because markets have sped up a little bit since the time of Gann. The same principles work, just a little bit faster. Looking at the Australian dollar, this is the daily bar chart for the year. This was the beginning of 2025, and you can see for the vast majority of the year, we've been in a pretty choppy sideways move. In April, we dropped into a big low on the 9th, and then we rebounded strongly out of there. So we've had a big whipsaw there. What was happening there was the end of a cycle, and Gann said that large moves or large fluctuations happen at the end of cycles. Now, since that whipsaw, which happened over a couple of weeks, the markets have again returned to a fairly flat bias. I think that this market is going up, and I'll go through that in a moment with you, but I wanted to give you something. For those who have been around the channel, you've seen me talk about part of this over time, but I just wanted to put this together for you. This is my 3-step trading system. I'm not going to go into the full details of everything. I just want to give you some pieces to give you some thoughts, because I believe every trader should build their own trading system based on what works for them. I know when I was a new trader starting out, I just wanted someone to give me a trading system so that I could use it. And there are trading systems out there, and I'll recommend one later for you. But at the end of the day, even if you do buy a system and it is a good system, it needs to be able to work for you. If not, you need to be able to tweak it so that it works for you, or you put it aside and you build one for yourself. So my 3 steps. Number 1, I begin with a forecast date. So if you want an example of that, you can check out my video on this channel for my Aussie dollar May 2025 forecast. The cycles that I use for my forecast dates come from WD Gann's novel, The Tunnel Through the Air. And if you'd like to get stuck into some research on that, I have created an audiobook of that. It is on the channel for you to listen to. I listen to it as well. There's plenty of information in there. So if you're someone who spends a lot of time on the road or going for walks or on public transport, there's an opportunity for you to put that time to good use and delve into Tunnel Through the Air a little bit more deeply. Now, as I said, I always begin with a forecast date. When it comes to WD Gann time cycles, I know of more than a dozen of them within the Tunnel Through the Air novel. However, and this is so important, you only need one to begin. People get so caught up in trying to decode and decipher the entire book that they forget the reason that they got into trading in the first place. For me, I got into trading because I hated my job with a passion. I really hated it. Probably wouldn't say with a passion because it made me so depressed I didn't have a lot of passion, but you get the idea that it wasn't much fun. So I got into trading to make money. When you get into trading, you find it's a big field. There's a lot of stuff there. There's literally hundreds, if not thousands, of books and courses that you can buy to learn trading. And you think the more I buy, the more I learn, the more I'm going to earn. And while that's true on some levels, you don't need to spend 10, 20 years studying all this stuff before you can make $1 from it. There's a video on my channel, and I'll show you the slide in a moment, where I made a 16-to-1 reward to risk ratio on a trade in a couple of days using the most simple trading system that any of you could learn in about 5 minutes. So whether you're looking at trading systems, whether you're looking at price, whether you're looking at time, just keep in mind you don't need to have everything worked out to the highest level and have 20 screens running and have AI trading systems and all this sort of stuff. You just need a few simple things. And for me, the first thing is a time forecast. And when it comes to time cycles, one is better than none. Obviously, you can add a few more as you go later, but get one working first. And then when you've got that, you can start combining your price setups with time. And that's a powerful combination by itself. So step one is the forecast date. Step two is to look for a trading setup. Now, again, there are a million ways that you can trade. There are 4 kinds of setup that I look for, and one of them you'll find in this video on the channel, which was a double bottom trade on the Australian dollar US dollar that made 16 to 1 in just 2.5 days. But there's a key thing that I want to point out here. Number one, the trading setups that I look for, they stand alone in isolation. If I see them on any day, I'd be happy to take them. I have strict criteria, and if they're not met, I don't trade. But if I can take one of those trading setups and it all comes together and attach it to one of my forecast dates, then I know I've got a pretty good basis for a trade. After that, the third and final step in my trading system is to take a smart trade. Now, you're probably thinking, well, why wouldn't you take a smart trade? Who would take a dumb trade? Well, if you've been around trading long enough, I can assure you, myself, and I know the vast majority of you watching have probably taken dumb trades before. It's something that we do as traders. It's almost like a rite of passage. We take the dumb trades and we learn from it. But for me, a smart trade is actually an acronym. And this is something that I've put together. It's my own work. So much of what I teach is the work of W.D. Gann, or it's work that I've learned from other people, or little bits and pieces that I put together from various coaches and mentors along the way. But this is something that I've put together for myself based on my personality and what I need from the market and what challenges me in the markets and where I've gone wrong in the markets and where my best trades and worst trades have come from. So SMART stands for S is small risk on entry. M is then move stop to break even quickly. A is to accumulate a position with the market's money. R is to read the market, and T is to take profits. So I'm going to run that through very quickly. At some point in the future, I might build that up a little bit and go into a bit more detail for you. But for this video, which is already going to be long enough, I just wanted to give you a few concepts to think about. For me, number one there is a small risk on entry. Too often we wait around for a trade, and sometimes you can wait days, if not weeks, for a trade, and then one finally comes along and you feel like you have to take it because you're a trader and it's part of your system and there's a trade signal that's been given to you. However, for me, what I've realized is that the Australian dollar, on a good move, it might go 1,000 points for a monthly swing, maybe a little bit more. If I have a risk on the trade that's too large, right from the start, I'm ruling myself out of a high reward to risk ratio trade. So if I'm risking 200 points on the trade and I'm expecting to make another 800 or 1,000 points, that's going to take a while to reach my profit target. And even if it does, I'm not making that much money anyway. My return on investment is not that big. However, I can take a smaller trade that might run like the double bottom trade on the Australian dollar over a few days, and I can make a 10, 15, 20 to 1 trade purely because my risk on entry was small. Now, a small risk on entry gives you a bigger position size, and that's how I prefer to trade. Fewer trades, but I like to go with a bigger position size with a smaller risk in points and the same risk in dollars. Now, you can play around with this. For example, if you want to risk $1,000 per trade and you find a trade with a stock with $1 risk, you can trade 1,000 shares. However, if you can get in with a 10-cent risk, then margin permitting, you can potentially, for that same $1,000 risk, take a 10,000 share position. So as the market moves in your favor, you're going to be making money a lot more quickly. If you're wrong, you'll still lose the same amount of money, which is your $1,000 or whatever you wanted to risk on the trade. But if you're right, you're going to make so much more money. And for me, that's what I wanted. I wanted to get that bang for buck because it helps me to stay in the trade longer. If you're in a trade, it's mucking around a little bit. There's no big potential profit there to incentivize you to hang into the trade. It gets a lot harder to hang in the trade. You start talking yourself out of staying in the trade. However, if you take a small risk on entry and you've got a big position, that's when it can start to affect your emotions. So for me, I like to move to a break even on the position as quickly as possible. I'm almost always, whenever I take a trade, I'm almost always at break even within 24 hours of taking the trade, and usually within 1 to 3 hours of taking the trade because of my style of trading. So a small risk on entry, then get to break even. And if you can just master those two things there and focus on trades that fit those two criteria there, your trading is just going to go through the roof over time. It takes time because you don't always get a small risk. You wait a while for a trade and you have to let some go because the risk isn't small. But if you can get those criteria there and then move your stop to break even, you'll find you're taking better trades. And your psychology is a lot better too because you're not sitting there with a fear of a big risk because you've got a big position there. Now, obviously, I trade the currency markets, which are open 24 hours, 5 days a week. I wouldn't recommend doing this where you load up on a position, trading a stock, which is only open 6 hours a day and then closed for 18 hours. Because if you load up on a position and then the market gaps against you, well, that can be a problem in itself. Now, if you don't understand any of what I'm talking about there, just relax, but don't try and apply this until you actually understand it. For me, the small risk on entry works really well on the currency markets, and I tend not to hold positions over the weekend because that's the only time the market can gap. Now, full disclosure, in the past, in my early years of trading, I have blown up a couple of trading accounts. And you blow up trading accounts by taking too many positions or too large of a position, not trading with a stop loss, all these sorts of things. I'm sure some of you have blown up trading accounts as well. Or maybe I'm the only trader in history that's done it, but I'm pretty sure I'm not. But another thing that I liked to do is accumulate bigger positions. So as the trade moves in your favor, buy more, or sell more if you're in a short trade. Now, if I'm in a trade and I'm at break even, I like to accumulate positions with the market's money. And as I do that, I move my stop loss up so that in all stages, once I'm at break even here, I keep my stop loss at break even. So once this has happened, I grow my position over time if the market lets me by buying more or selling more and then moving my stop loss up to lock in more profit and lock in at least a break even on the trade. Then it's really important to apply your form reading skills to read the market and finally to take profits at the end. So these are the 5 things that I focus on in my trades. I want that small risk. Once I'm in, I want to get to break even quickly. I want to accumulate positions if I can because I don't take all that many trades. So once you're in there and you know you're right and you know you're protected, it's good if you can, and there's a few steps to this, but it's good if you can to increase the position as you go along. It's like free money, unless you get stopped out by overloading. But that's a discussion for another day. Reading the market, or form reading the market as Gann would call it, is one of the areas that gets the least attention from traders, and it should get the most attention. I'll show you where you can learn that in a moment. And of course, at some point, you have to take profits. Don't try and hold on to the last cent of the trade. Have a plan so that you know where you're going. I'm going from, I don't know, $10,000 up to $10 million. That might be your plan. And map it out along the way so that you have checkpoints that you have to reach. And at some point, if you can take profits and you can reach one of those checkpoints, just take the profits on the trade. I've seen too many good trades to go on for a long period of time. People get comfortable with them. People get excited by them. People get cocky with them. And then the market turns around and in one day wipes out 3/4 of the move. At some point, you just take profits and then you get set for the next trade. Now, that's a bit longer than I wanted to spend there, but these are important points that you can incorporate into your trading and that I would suggest that you consider with your trading plan. So always try and keep it simple. Trading is fast paced, and if you have a long, complicated system, you're going to find yourself chasing the market or jumping in and getting kicked out or making mistakes. So keep it as simple as possible. Look at my 3-step system. It's a cycle, gives me a date, a setup, which gives me an entry into the market, and a smart trade, which gives me parameters for managing the trade. It's not perfect, and I don't think anyone's trading system is perfect, but it's workable and it does the job for me. And again, if you haven't seen it, check out that double bottom video on the Australian dollar because I show you in there exactly how I set up for it, how I read the charts. The final thing I'll say there for you though is to find out what works for you. In order to get a small risk on entry, I either have to trade very close to the market or use a low time frame swing chart, like a 5 or a 15-minute swing chart. That increases pressure. It increases the time commitment in front of the computer at certain times of the month when you're looking for that. And that may not work for you. If you're working full time, that may be a bit challenging, and maybe something like a 4-hour swing chart might be a better option for you to trade. So find what works for you now and fine tune it until it's workable and then go from there. Let's push on with the Aussie dollar US dollar now. And you can see while it's been sideways really since the middle of April, about a month and a half almost since we had that big spike up, you can see that on the monthly chart, we have gone above the 62.5% retracement. So we had a failed monthly swing down there. It poked through the 75% milestone in this crash here. And then a couple of days later, it came soaring back up there, and it not only regained 75%, we've now regained and we're trading above the 62.5% retracement level. For me, on the Australian dollar, this looks strong at the moment. The key level will be this 67.5 cents there. Everyone's talking about the Aussie dollar going above 70 cents, and I think it will go there, but that's going to be the key test point. Even if you don't use these Gann tools, I would mark that 50% on your chart somewhere and just remind yourself of that, because if we come up and we fail at that level, I've seen a lot of markets tank at that level and then collapse. If we get above there and make a higher bottom above there, say on the weekly chart or higher time frame, I'd say that that is a major low on the Aussie and we're going up for a while. Now across here is my weekly chart. You can see that we almost took out last week's high there on the bar chart here. If we do that on Monday, that's going to give us a weekly higher swing bottom. You'll note that it's a 25% retracement there. I don't trust a 25% retracement. Sometimes it will hold the market and will run up from there. But to me, with these, they're called a ranges resistance card. You'll see them in Gann's book, How to Make Profits in Commodities, Chapter 2. But with these ranges resistance cards, for me, the sweet spot is 37.5 to 75%. The vast majority of successful trades that I've taken using a resistance card as one piece of the puzzle. For price forecasting, there's three things that I do, and this is only one of them. But when I use it, I'm looking at 37.5%, 50%, 62.5%, and 75%. So I'm questioning that there. You can see on the daily chart, if you run a trend line from the 7th of May top through to the next lower top there, we have actually just poked our nose above there. And we've had this upward line here that we sat on with Friday's bar there. So it does look like it's all set to go up. What markets tend to do is they will break a trend line, maybe even break that top there, and then come back and sit on that trend line. I've got a top there on a particular cycle, and the low for that cycle, and this is pretty close to the pattern that the cycle was showing, so I'm pretty confident that we are following that cycle cleanly. That 7 May top is due to have a low, so from that high down to a low in very early June. So right at the end of May or right at the beginning of June, you've got a cycle low there. This low was the 23rd of May. That's too early to be that low. So even if we go up and we take out that top there, and I do think we're going to do that, and I think that we are going up, whether it does it in this week or a week or so after that, I don't know. But if we go up at some point, I'm looking for it to come back and sit at least on or just below that top, maybe a bit further, and that's where I'll be looking to go long from. And that will be right at the end of May or early June. So people have said to me, oh, did you get long there? Did you get long? No, I didn't get long. That's a sideways, choppy, awful move there. I got long out of the April low down there on the double bottoms. I didn't do much through here. I got short at that top. I traded that exact move down there. That was nice and clean and easy. I was looking to get short around the 19th, and I did get short, got stopped out for a break even, got short again at the little double top there, got stopped out for a break even. I saw this down here. We were struggling. See, on Friday, we ran down. This is a 4-hour chart. It's much more clean and clear on the 1-hour chart, but it was really struggling to go down. I thought that's probably it for the low. We'll probably pop up from there, but I didn't get long. As I said, I'm going to wait until right at the end of the month, so another week or so, end of May, early June, and I'll be looking for a low to potentially get long from if I can find a strong setup. Sometimes your forecast date will come in, but you won't get a setup, or sometimes your forecast date will come in, you'll get a setup, and you won't get a small risk entry. And these are all decisions that we have to make as a trader. And for me, over many years of getting to know my market and getting to know myself, that's what works best for me as a trader. Now, there's a lot more I can go into with that. I'm going to leave it there for now because I have to move on to other markets. Let's move on to the British pound US dollar now. And you can see these potential double tops have been broken. If you've been following the channel, we had a top here, and then we were sitting last month, being April, right on that top there. As I said, we had a stronger run up here. To me, it looked like it was going to run through, and now it's looking like we have poked through and we're going higher. There was a potential there for double tops. They were sitting on a major 50% milestone. I'll talk about that when we look at the euro, but they were sitting on that milestone. Potentially the pound could have gone down from here, and it hasn't. Again, that's a sign of strength. I'm seeing a lot of strength in the Aussie, the pound, and the euro, and I think that we are going to go a fair bit higher on all three of those currencies. Let's just take a look at a few things here. firstly, on the weekly chart here, I spoke about this low here as maybe being the beginning of a new large move because we had a run up, pull back, run up, pull back, run up. That's what Gann would call 3 sections up. Then we had a strong pullback there that cleaned out all of these lows. Now, potentially, we've got a larger range there that we can start running up. Just ignore all these numbers here. They're irrelevant now. I'm not sure why they're still on the slide here. I made a mistake there copying that, but that's fine. Everything else is correct. So ignore these numbers. But to me, this is a new low down here, and that's our first run up and a pullback there. So we've cleaned out that top there. We've cleaned out the monthly top there. This could go on a bit of a run. And we spoke about this in last week's episode of the Forex Form Guide. We were sitting around here at this low here on the little double bottoms there, saying if we go up there, that's going to be a higher bottom and it's going to start looking strong. I want to go into that in a little bit more detail now for those of you who are new to all of this. Let's take a look. That's the weekly chart, and that's the little pullback that we've seen there. Okay, so it's just a simple weekly chart, and you can see a higher bottom there on the weekly chart. If you're a safety in the market student, you'll know that's an ABC long trade, which is not something that I would take in isolation. I use the ABC formation and I look at the swing charts in that exact same way, but I look at them across multiple swing chart timeframes all the time. And I want to show you now how I do that. So I just want you to picture this. That's a good strong weekly run up and pullback, but you've got this, there's your weekly pullback. Let's look at that weekly pullback on the daily chart, which is this chart over here. So on the daily chart, there was the top. That's your weekly top here. And that's that weekly top there. You've got a daily swing down, pull back up, and then a bigger daily swing down. Okay, that's looking strong, and that gives you that low over there. You don't know it's a low at that point. The market rallies, I'd argue not strong enough to say it must be going up from here, but it gives you a bit of a rally, and then it starts pulling back again. If we put in a higher bottom here, there's a good chance that a higher bottom here, which is what we got, but you don't know that at the time. But if you put in a higher bottom here, there's a good chance it means this weekly swing is over. And if this weekly swing is over, well, your trend is up. It's looking strong. It's less than a 50% retracement. It looks like you're going higher. So how do we know it's going to be there? Well, you don't necessarily know, and you can have a look at it. It ran up, pulled down. You just wait for the market to confirm that higher swing bottom by having a higher bar there. Now, if you're not a swing trader, I'll show you where you can learn that in a moment and where I learned it from, but it's crucial if you want to trade Gann that you understand bar charts and swing charts, because a lot of people with Gann, they go straight to the complex time analysis, where really what they need to do is work on the form reading first and get a plan in place so that they can make money and stay alive as a trader long enough so that they can learn all the best stuff of Gann later. Arguably, this is the best stuff. It's learning the bar charts and the swing charts, but I'll leave that discussion for another day. So let's have a look. You're sniffing out a potential higher bottom here on your daily chart. Let's break down this move here by dropping down another time frame to our 4-hour chart over here. And that's what it looks like. You've got a run up and pull back. That's actually your higher bottom there. That bar there was a couple of points lower than this one over here. But see, the market ran up, would have ticked you into the trade, and then it did everything in its power to stop you out and freak you out that day. If you didn't get stopped out, which you didn't if you had your stop below the low there, but if you didn't get stopped out, you might have jumped out of fear because the market just tanked through those 3-4 hour bars there. Bang, bang, bang. But it was a higher bottom, arguably a little double bottom there on the 4-hour chart. And then look at this period here on the 4-hour chart. The market runs up a little bit. It shot up a little bit, pulled back down, give you a higher bottom there, and then bang, off it goes. Once that's confirmed there, there's your first higher bottom on the daily chart, and that confirms that this run down here is over and that weekly swing is over. Once that weekly swing is over, you're running up from there. Now, you want to know when that weekly swing is over as quickly as possible. If you're just looking at a weekly time frame, that weekly swing's not over until you cross this top over here. If you're looking at a daily time frame, that weekly swing is not over until you cross this top here, which is about 133.25. This one up here is sort of 133.55, 60. That's an earlier one there. Over here, see, you've got the daily swing down there. That's your daily swing. And then it puts in a little higher bottom there. Okay, and you can either put your stop there where you would have been stopped out, or you enter and you put your stop below the daily swing over there, and you would have stayed in the trade. But that's how you use multiple swing chart timeframes to confirm that a larger swing chart timeframe has given you a signal, given you a higher bottom, or the trend has changed, etc. And this is something that I would really encourage you to spend some time on. The only two places that I recommend people look for this, and just trust me from someone who has bought dozens and dozens of courses and seminars and webinars and books and all sorts of packages and training and mentorships. These are the two places that you need to go. How to Make Profits in Commodities by W.D. Gann has a whole chapter on form reading and on price forecasting. They're in the same chapter. And Safety in the Market's Active Trader Program online training, which is where I learned it from. I was a student of Safety in the Market 20 years ago. I was a teacher for a time at Safety in the Market. I'm very fond of Safety in the Market, but I don't get anything for saying this. I have no affiliation with them anymore. I'm friends with several people there, but I don't have any affiliation. I'm just telling you with the intention of being helpful. I know a lot of you are Safety in the Market students. I know many of you are Safety in the Market students already, but if you're not, and if you're looking for some training, that's one that I'd recommend just checking out and seeing what you think. It's the only stuff that I trade. My 4 setups that I trade, they've all come from here. All right, let's move on now to the Euro US dollar. Now, I'd like to lead with 2 Gann quotes before we get into the euro because they're going to be important for when we analyze the euro. These 2 quotes are taken from Gann's book, How to Make Profits in Commodities. The first is to divide the range of fluctuations by 8 to get the 1/8 points. And the second one is you can make a fortune trading the 50% rule alone. Now, I don't recommend trading the 50% rule alone, but you'll see over time just how often the 50% point comes into play in market. So it is worth doing some study and research on. Now, they're taken from How to Make Profits in Commodities, which is a great book, but it's also a very dense book. I have to admit, I did the Safety in the Market work first, and that explained everything really well for me. And that meant later down the track, I was able to go in and get some more value out of How to Make Profits in Commodities. The information is there in How to Make Profits in Commodities. It just takes a fair bit of work and time and thinking and research to draw out. And in this day and age where things move very, very quickly, time is valuable. So if you can get a little bit of a leg up, it's always worth considering. So looking at the euro now, if we take this large range from the July 2022 low, running up for about a year there, and then we look at the pullback there, we've seen that run up very, very strongly in just a few months. And these current lows are actually sitting on that 50% milestone. So the euro has broken 1, 2, 3 tops there. It's then come back, as markets often do, it'll come back and test those old tops. And it has sat there right on that 50% milestone as a percentage of that last range up. And as we look, today's the 25th of May, so we're towards the end of the month. And the euro, while it's run down and tested that low, it has now come back. It's trading near its high, it's above its open, and it's above last month's close. So it's looking like it's found some support there on that 50% milestone. You've got a slightly different formation here on the euro compared to the pound. The pound has actually run up on the weekly chart and made a new weekly high, whereas the euro is still potentially setting up for a lower top there on the weekly chart. And maybe the euro does have a little bit more of a pullback just to confirm a little bit, and then it runs up from there. Maybe it just has a slight down bar at some point and goes up. I still think the euro is going up. I think that's strong, and this is a very big range here. So as long as we hold that 50%, I'd say we're going higher up to at least that 100% point there, up around that 119, 120, and probably further, to be honest. So I think there's a lot of upside potential in the euro, not a trading recommendation. And by the way, I can think the market's going up, but even if I think a market's going up, if I don't have a setup and if I don't have a small risk on entry, guess what? I'm not taking the trade. By the way, this is a little bit of a sidetrack, but if I look back over the times that I blew up my trading account, on the trades where I blew up my account, both occasions, would you believe I was right on the trade? Let that sink in for a moment. I've been wrong plenty of times and made money, but when I was right, I lost money. For me, I actually did the same thing twice and I blew up 2 trading accounts to have to learn that lesson. But what I did was I was right, but I kept loading up and maximizing my margin, and I didn't use stop loss orders appropriately, and the market turned around. If you keep loading up on contracts, it gets easier and easier for the market to just have a little bit of a whipsaw down, bang. You might be thinking we're going up, and we are going up, but you just need a little bit of a flick back like that, few hundred points, and bang, you're wiped out if you're not trading responsibly. Or, as I said earlier, if you're not taking a smart trade. For me, I took a couple of dumb trades, and that's all it takes to really tear into your trading account. So even though I think this is going up, I'm smart enough to know that A, it can come down and have a little bit more of a pullback first, and B, if I don't have a trading setup with a small risk on entry, yeah, the market might go up, but I'm not going to get a decent return on the trade anyway. So why would I put my money at risk if there's not a strong likelihood of a great return on the trade. It's just silly. Yes, I've done silly things as a trader, but these days I try not to. So let's look at the smaller swing chart timeframes now. On the euro, yes, that's a potential higher bottom there, sitting on that 50%, but I've always maintained this market can have a pullback on the monthly chart without interrupting this big trend here, because we've had a nice strong run here. We've cleaned out those highs there. Maybe it does have a little bit of a pullback, maybe into early June again, give you a higher bottom on the monthly chart, and then run up from there. And while we're on that subject, if the euro was to pull back, there's a very, very nice setup around that 50% milestone, around that 108.75. Now, it will depend on what happens this week, of course, but if the market was to turn around and come back down, that would be the area that I'll be watching there. And just picture that for a moment, a monthly chart sitting on a bigger 50%. And this is why you can't trade the 50% rule in isolation, because you've got a 50% there at 110, you've got a 50% there at 108.75. If the market's going up, it can rebound off either of those, and they are both acceptable. In this case, of course, if the market does go down to that 50%, well, they both worked in essence, because that's given you a higher bottom on the weekly chart on the 50% over there, and that would give you one potentially as well. But that's an area, if we do go down, and I think the Aussie's got a little bit more to go down. If we do go down, that's an area that I'd be watching very closely. But just think about that for a moment. A 50% retracement, if you can get a really tight price cluster there where you can take a trade with a small risk on entry, if you're on a monthly chart, and that monthly chart has gone, what, 1,400 points so far up there, if you can get anywhere near a monthly swing low, even if you get in within 50 points of that monthly swing low, if it goes another 1,400 points, then that's a 28 to 1. If you go 1,400 points on 50 points risk, that's a 28 to 1 reward to risk ratio. And I don't need to tell you the maths. If you can get that 50-point risk down to a 10-point risk on a 1,400-point trade, that's a massive reward to risk ratio. And remember, that's just your initial position there. Now, these sorts of trades, they don't show up all that often. This is a monthly chart on the euro. If you look at the monthly swings, they've been pretty choppy and sideways for the last 2 years or so. Looking back there. Now, I'm not saying it will go down to 50% because it's recovered all those highs there. I'm just saying if it was to go down to that 50% there at 108.75, and if you got a trade underway, and if it put in a monthly higher bottom at that point there, there's a lot of potential for a high reward to risk ratio trade. And I know traders who will just look out for 2 or 3 of these per year, and you get on one of them, and as I said, 10-point risk, 140 to 1 reward to risk ratio. You add 2 or 3 times along the way, maybe as your weekly gives you a higher bottom, your daily gives you a higher bottom, etc. Maybe trade again as some tops across, and all of a sudden, you've got a pretty healthy reward to risk ratio on that trade. You don't need to follow 100 markets and trade them 20 times a day each to make good money in trading. You just need a good, smart trading system and to get in at the right time in the right market, preferably at the right time, and to get in at the right price, and preferably at the right time as well. Now, looking at the euro again, there's our run down and our run up there. Similar to the pound, we had a pullback there, a run up again, a little bit messy through here, but we've had our runs through there and a higher bottom there on the 50%. It just remains to be seen now what happens here. Does the euro continue to push up? If we go up Monday, Tuesday, probably we are going higher. If we break above, say, that 114 level and keep going up, then there's every chance that we take out that top and keep going higher. If it peters out a little bit and struggles here, that's when that 50% comes into play. I mentioned in last week's episode of the Forex Form Guide, this is an overbalance in price potentially compared to this run down here. And if you're not sure what that means, check out the video on this channel called How to Spot a Market Turn. An overbalance in price is one of them. So as I said, I'm wary of that. Now it's sitting on 50% and you've got the daily higher bottom there sitting on 50%. It's giving the impression that it is going higher. However, that overbalance, it just makes you question, are we going to go down a little bit more into that 50% milestone? I certainly think so on the Australian dollar. The euro is not one that I've traded for a while. But looking at that, if I was looking at this in isolation, forget every other market, I'd say there's a decent chance that we are going to pull back, have a little lower top on the weekly chart, pull back into that 50% there. Okay, but that's dependent on this being the top here. If we start going another 100 points higher or so, then I'd say that's it. We're going to go higher and push on straight away. Long term, I think we're going up anyway. It's going to go higher, at least 119, 120, probably higher than that. Okay, short term, we'll see what happens this week. If it goes another 50, 100 points higher, then this is ruled out for me as a seller. But I do like that. I do like that 50% there. We'll keep an eye on it. And as I say most weeks, as a trader, it doesn't bother me to have multiple viewpoints on a market. It's quite common. I'll say if we go up there, I may get a trade. If we come down here, I may get a trade. Why is that? Because I have my cycle dates. I can say, if we go up to this point, and maybe that's in 6 months' time, well, in 6 months' time, I'll check my cycle dates. Am I near a cycle date? When that happens, do I have a trading setup? Can I get a small risk entry? That's all I'm looking for here. Final one we'll take a look at is the US dollar Japanese yen. And I've been talking about this for a little while, and not much has changed in my viewpoint this year. We had that big lower top on the monthly chart, and we've run down to potential triple bottoms there, but we're just above that previous bottom. Not much different from probably the last 6 times I've done the Forex Form Guide. I'm going to be saying the exact same thing. I think that is going down. 116 is my target there, maybe further, but I think those triple bottoms are not going to hold. We did get very close here on the weekly chart to what's called an overbalance in price to the upside. We didn't quite reach it. So we had a bit of a fight there on the weekly chart. Looking here though, after this top has come in, we've had a pretty strong run down. And you can see all these days down here. At some point, this has to rally. It will probably do it early this week into potentially a lower top there. Or maybe it goes up to a 50% retracement. That's on the cards as well. But maybe it goes a fraction further down and then goes up. But I can still see that putting in a little bit more upside there. On the subject that I mentioned earlier about blowing up trading accounts, here's another thing that I'll throw in there. It's when you jump into a market and you say, oh, this has been going down for a while. Oh, yeah, the trend is down. Oh, this market's really weak. When it's been running for a while, you just get that increasing urge, and maybe it starts here. What was that, Tuesday last week? You say, oh, it's been running down for a while. I'm going to get in, and you don't do anything. And the next day it goes down. Ah, oh, yeah, I knew it was going down. This is really weak. And then the next day it tries to go up and it can't. You say, oh, I tried to go up and it failed. This is really weak and I want to go short. And then you don't. And then the next day it runs down and closes on its low. You say, ah, oh, that's it. I'm going to smash this now. And then the next day is when it shoots up and has that big run to the upside. Now, you don't always know when that's going to happen. There are ways that you can do it. And sometimes you can get really, really close to these turns. But for me, if I can get in up here, great, I'll take a trade. If I can get a small risk on entry, gives me the best possible chance for a high reward to risk ratio trade. And the benefit of a high reward to risk ratio trade is that if you've been in a slump and you've had a bunch of losing trades, one high reward to risk ratio trade, as long as you've stuck to your risk and you lose, say, 100, 100, 100, 100, 4, 5, 6 times in a row, you get a 10 or a 12 or a 20 to 1 trade. It wipes out all those losses and leaves you with enough profit to pay the bills and feel like a winner. And it just turns your psychology around in one trade. I don't encourage people to just look for one trade to turn everything around. But the reality is there are trades out there that will do that for you if you have the patience to wait for them and if you have the knowledge and the skills to set them up. Let's move on to the economic calendar now. You've got Australian CPI year-on-year figures coming out Wednesday, 11:30 a.m. Sydney time. New Zealand cash rate, New Zealand dollar cash rate coming out. The economists are predicting a 0.25% drop in the New Zealand dollar cash rate. And Wednesday night, Sydney time, or early Thursday morning, you've got the US FOMC meeting minutes. And then Thursday night, you've got preliminary GDP quarter on quarter. That can be hit and miss. It can be a big move. It can be a small move. Prediction, interestingly, is for a minus 0.3% there. Obviously, with GDP, 2 negative readings quarter on quarter in a row will give us a technical recession. So obviously, the market might be a little spooked if we see that. But that could be an interesting date to watch a number of our currency pairs on. And then on Friday, you've got the German preliminary CPI month on month, Canadian GDP month on month, and for the US, you've got the core PCE price index month on month. That's all for this week's episode of the Forex Form Guide. A little bit longer than normal. Let me know in the comments, would you prefer a short, sharp video where I spend 30 seconds to a minute and just go bang, bang, bang. Here's what I think of the Aussie, the pound, the euro, the yen. Bang, see you later. Have a good week. Or would you like me to delve into it a little bit more and give you that longer content? For me, I always aim around the 20 to 30 minute mark. Sometimes I go a little bit shorter, sometimes I go a little bit longer. But let me know in the comments. I'd love to hear your thoughts on that. That's all for this video. I hope that you found some value in it. A reminder, if you are new or if you've been here for a while and you've got some catching up to do in videos, there are some videos there in that new here watch these videos playlist that I think you'll get plenty of value out of. And if you did find value in the video, I would really appreciate it if you could just drop a like and leave a comment, because it does help the video get pushed out to more people. As you see with this video, last week, we got some extra likes there. Thank you to everyone who clicked like, and it went out to 2,000 people. So the videos tend to get picked up and pushed out a little bit more. YouTube says, oh, people actually like this video. Let's show a few more people. And if you think about it, in this day and age, we have cost of living crisis. We have job security on the decline. We have a generation of young people who are idealistic but will struggle to afford a home for themselves, let alone have the money to go out and do all the good things that they want to do in the world. Well, Gann analysis is a pathway into financial freedom for people. And I know that it works, and I know that it can work for you, and I know that it can work for other people as well. So for me, one way that I can give back is to promote the work of Gann to those who need it. Gann left behind his work for us in the form of books and courses and Tunnel Through the Air. And more than one of my mentors have said they believe that the reason Gann did that is so that he would be able to reach higher levels by helping people like you and me who are seeking that knowledge to better our own lives and to better the lives of others. Imagine a country where you've got an army of traders who know this stuff and use it well to call market turns. Imagine what they can do with the time and money and freedom that that brings them. Food for thought. That's all for this video. The Forex Form Guide comes out 7 p.m. every Sunday. And if you subscribe to the channel and turn on notifications, you'll be notified when that video comes out. I'd like to wish you all the best for the week ahead, both for your trading and for your life. Have a lovely week, and I'll see you next Sunday for the Forex Form Guide. All the best. Bye for now.